Welcome to the InterMarket analysis video update. This is a weekly video where we look not only at the valuation of the S&P, but we look outside of the S&P at other markets to see, are we getting any clues as to what's happening? And there's potentially a pretty big clue that we saw on Friday, and I've been bringing it up in some of the other videos, but I want to bring it up here again with more charts. It may not be anything, but it's something that I picked up on Friday's session, in Friday's session, and so we'll see if it leads to anything, but we'll get to that a little bit later. And this is being prepared for Monday, November 10th. First, if you're new to the videos that I post here, I have another thing that's called the SPX Investing Program. It's a website. There are additional videos that I post. In fact, this video and all the videos that I post, you get immediate access to those as soon as they're uploaded, where I delay them on YouTube and Rumble. And there's two parts to this. There's the full-blown program through Substack, where you do have to provide payment information. There's another website called spxvideos.substack.com. You still have access to everything there except for the additional things that I post on the full-blown website, but you don't have to provide any payment information to access that. And from now until the end of 2025, that is free. So check it out. See if you find it helpful. Okay, so what will I be covering in this particular video? First of all, as I said right at the beginning, we'll go over both historical and forward-looking valuation. And just to tell you, we're overvalued. And we start going down, having a little bit of trouble later in the week last week, and immediately, poof, valuation concerns. That it's kind of a catch-all excuse whenever we start to go down. We've been overvalued for years, and yet we see a little bit of a pullback. Oh, valuation, valuation. And then things kind of recover and we start going back up and people kind of forget about it, although we still look at it every day. Seems like we look at it every day. I get lots of charts in the daily videos that go through and just show us the same thing day after day. Yeah, we're overvalued. Well, we break it down a little bit more here, put it more in its own section rather than just one or two charts in the daily videos. Then I do a pretty extensive analysis between growth and value. We want growth to be outperforming value when we're going up. That's a more offensive market. When value's outperforming growth, that's more of a defensive market. And in the bigger picture, we're still seeing growth outperforming value. It's still quite positive in the bigger picture. What we've been seeing going back to August, and then it kind of drifts in and then settles down a little bit. Now it's drifting in a little bit more, is on a shorter term basis, we're seeing the market becoming more defensive, meaning value, especially this past week, outperformed growth. That's not what you want to see in a real positive environment. That's the smart money shifting over to more defensive stocks that tend to do better when we're going down. Also, we're seeing a little bit of flight to safety. Stocks are getting sold. That money comes out of the stock market. It goes into the bond market, especially in Friday's session. That's why we saw stocks going down. Now, we had a pretty impressive bounce in Friday's session. We also saw a little bit of this on Thursday. Not so much a rebound, but we're wondering, can that rebound carry over into the upcoming week? But even with the rebound, value still outperformed growth on Friday, and the market is still becoming more defensive. But in the bigger picture, it's offensive, not offensive, offensive. Okay, and then we take a look at inflation, which really doesn't seem to be a concern right now. We do look at other markets just to glance at them and see, is anything really weird happening? Not really anything. The only other market that we have been keeping an eye on that's looking a little weaker and kind of defying everything right now is Bitcoin. It seems to be having some issues. It's still in an uptrend, but another week or so of weakness, and we could see that actually turn into a downtrend. And then we look at the 11 sectors of the S&P and then compare them with the S&P, different indexes, and then correlations between different markets, some very long-term trends based on monthly charts. And then at the end, I have a positive and negative list just to spoil the ending now for a number of weeks. Actually, it's been maybe a month or so. We really haven't had a change in that list. The Japanese yen is in a downtrend to the dollar, and the dollar is still in a downtrend. But we've been seeing some intermittent strength in the dollar index, so we want to keep an eye on that. because the stock market likes a weaker dollar. And if the dollar is starting to go back up, that could put some pressure on stocks. And I say that over and over, but we watch the same thing over and over to see how it's playing out. Okay, valuation. When we go back and look at earnings reports that have already come out, we're overvalued. You can see here at the top, we have the static numbers of PE 10, 15, and 20. And then at the top here in black, that's the price of the S&P, and you can see how far above we are from the PE ratios. But we've been that way for many years. We spend considerable lengths of time above the red dash line. So it's not really telling us anything new. We don't use this for timing. We just use this to justify, okay, yeah, we're overvalued. Tell us something else that's actually useful. But it's still kind of a good idea just to keep an eye on this. And then down at the bottom, I have a spread between the current price of the S&P and the red dash line, also quite overextended. This is that same thing going back to 1980, showing how we spend long periods of time being overvalued in the market. This is another kind of adaptation of the PE ratio put out by Robert Shiller. Also coming in at 39.67. Very, very overvalued when you compare it to the median and the mean between 16 and 17. Then the market uses forward-looking PE ratios, and even on this side, we're quite overextended. We actually got above 30, almost to 32 with the mega cap 8 as they're measured here. Usually it's a magnificent 7 that most of the market focuses on. But it did drop down a little bit, but it's still way over that 20 level, coming in at 29.6. The S&P was up over around 23 or so earlier in the week, and now it's dropped down to 22.2. Again, overvalued because it's above 20. And then more fairly priced is the S&P 600 small caps, not the Russell 2000, but the S&P 600, coming in at 15.2, and the mid caps at 15.9. Now, it was hoped, and it's been hoped multiple times over the last few years, that small caps might eventually get to the point where they see some favor. Well, we see that scenarios start to develop, and the small caps and even the mid caps to a degree, they start to go up. Then the scenario changes. Nope, nope, nope. Doesn't look like we're going to get a rate cut in December after all. And now we see the small caps coming back down. Even though they had a pretty good day on Thursday, they didn't have a real good day on Friday. So just kind of hanging around because their indexes aren't really going anywhere. So their price to earnings ratio isn't really going anywhere either. All right, then we look at growth. Now this is kind of interesting. Kind of remember what this chart looks like, where we're still in an uptrend, but we're falling down below the 50-period moving average. All right, still positive, but seeing some weakness. Now the next chart is value. And see how this one is above the 50-period moving average. This is not what we see in a more positive climate. We see just the opposite. We see growth going up and value either staying the same or going up less, if not even declining. But this is above its 50-day moving average. So below right here, above right here. Now where we get more insight is when we do ratios between the two. You can see longer term growth is outperforming value, but we're coming all the way back down to the 50-period moving average. Then I have an inverted version of that same ratio, how value's been underperforming, but coming back up to the 50-period moving average. This is a market that could possibly be starting to get more defensive. Now, we saw that last spring. Everything was going crazy last spring. But then it finally worked its way out, and we started to go up again here. But then we hit some bumps, and we had a little bit of difficulty here going into August. We had a pretty significant down day. That shifted everything. Then we recovered from that. And now we're just going to watch this play out and see, okay, are we going to come down to this moving average and bounce up off of it? Maybe at some point, either at or a little bit below, stabilize and start to go back up, or are we going to see this continue to go down? If it continues to go down, that's the market still becoming more defensive. A very similar story here with some ETFs. Growth outperforming, but coming back to the moving average. Value underperforming, but coming back up to the moving average. The indexes coming back down to the moving average and coming back up to the moving average with the value versus growth. Now this one is held up a little bit better. It's a growth and value ETF ratio where we're still at the top end of the rainbow, but we are pulling back. So this is positive in the bigger picture, but can you see a little theme going on here? Whether we look at ETFs, we look at different types of ETFs, different indexes, Long-term charts, short-term charts, we're kind of seeing the same thing over and over. Bigger picture, growth is outperforming. Shorter term, it's beginning to underperform. This is that same ratio showing how value's been coming back up into the rainbow. Then we look at the small caps, which really had a very solid growth to value ratio here on the end of day chart. But you can see the index just kind of humming along, not really doing much. Little bits of hope here, and then it falls back. And then now we've been just more or less chopping sideways. And we were looking pretty good here with mid cap growth to value, but you see the index really just hasn't been doing all that much. And now we're actually seeing a bit of a decline where this ratio is headed back down closer to its 200-day moving average. The one that's a little more concerning is that we dropped below the 50-period moving average back in August with S&P growth to value, and we've just stayed there. We cannot seem to get back above it. So this is a market that at the beginning of August was starting to become more defensive. It's kind of hung on to that defensive nature, and now we're starting to even drop below the 200-day moving average. So this is a warning sign that, okay, we had a nice intraday reversal on Friday. If that can carry through, it might negate what we're seeing here. If it can't carry through and this is continuing to go down, be a little careful now because everybody is not everybody, but a lot of people are just thinking, well, it's November, the market's going to magically go up. We had 20 plus 20% gains in 2023 and 2024. Why should 2025 be any different? Okay, the market doesn't like that when it's taken for granted. And we are in the strongest part of the year. July and November are the strongest time for stocks. Well, so far in November, we haven't really been seeing that. Now, last summer, going into August, September, and even October, we typically see some negative seasonality. Didn't see that. Now, is the market playing the same opposite game now where we should be seeing strength and we may not see that? Or is there just enough that's going kind of crazy with the market right now with the government shutdown, with earnings kind of, we're still at the height, but it's going to start to trail off. And then there's this tariff case that's in front of the Supreme Court to see if the president has authority to be able to levy those tariffs. If they come back negative, what's that going to do? Because the market knows about the tariffs. It already dealt with the tariff issue going back to March and April. Everything was just going crazy then. Well, then it's like, okay, the tariffs are kicking into gear. The news isn't as bad as it was before. We're starting to go up. Hey, wait a minute. Inflation isn't all that bad. Earnings are still doing pretty good. Let's keep going up. Let's keep going up. Well, if all of that is thrown out, what's the market going to do? Because it's dealing with a known factor now that it's already had a chance to work through, at least as far as it can to this point. If that changes, what's going to happen? Is the market going to rally because it doesn't like tariffs? Or is it going to tank because it's been building in this idea that tariffs are a part of the US economic policy? And if that goes away, what's going to replace it? So, all right. Then as far as inflation, no, not really concerned. This chart's actually rolling over now that we've come into November. This was the only inflation ratio that we look at that was really causing any concern. It's a monthly chart of inflation versus deflation parts of the CRB index. But you look at the CRB index itself, it's drifting up a little bit. The moving average is going up, and we're just a little bit there above the moving average, but we're not really seeing any strong conviction longer term. Daily chart, CRB index, still chopping along sideways, not seeing a lot of conviction there. And we're underneath the 50-period moving average, but we're still in an uptrend when we look at the Baltic Dry Index. This is another way of looking at inflation for shipping costs. And it's really been going sideways a lot lately. So not really any concern there. And then there is an ETF that deals with inflation expectations. It's not really freaking out right now. It's just kind of range bound. And then we look at inflation expectation versus tips, starting to come back up here a little bit after we had been declining, but really just within this basic range that we've been in for quite some time. Then we look at aluminum, which is pulling back, but it's still in a longer term uptrend, where corn is coming back up, but still in a downtrend, as is wheat, continues to be in a downtrend. Fertilizer, it had been coming down. Now it ticked back up in the latest reading, but nothing too crazy to worry about there. Lumber is in a downtrend and below both of the moving averages. That's not inflationary. Oil, which again we follow mainly for geopolitical reasons. Now we were up a bit in Friday's session, but we're still just into the high 59 range. We're under $60. And then we look at the 10-year yield to oil correlation. Actually, a little bit of a tendency to go in opposite directions lately. So we'll just see. If interest rates are going up, that might mean oil's going down and vice versa. And then the gold to oil ratio, we've been seeing some recent profit taking in gold, so the ratio is coming back. Oil really hasn't been doing all that much, but when this is going up, that means gold is outperforming. And then gas is in a downtrend, but coming back up to its 50-day moving average. Heating oil is actually in an uptrend as we're getting a little bit into the colder months of the year. Natural gas breaking out a little bit here. This is something we want to keep an eye on. It's really starting to go up, but it hasn't surpassed the previous high set earlier in 2025. And diesel been going back up a little bit, but still pretty much going down in the bigger scheme of things. And then copper, which is a barometer for the economy, just chopping around a lot lately, but it's still in an uptrend. And then the copper to gold ratio, gold's been seeing some profit taking, copper's been holding up okay. So we're seeing this ratio coming down. But in the bigger picture, this is showing how copper's been underperforming gold. Same thing here, copper underperforming gold, that's the black ratio here. Also plotted is the 2-year yield and the 10-year yield, which have also been coming down for the most part. And then gold, we're just shot off to the moon here. Now it's kind of been drifting back down to earth, but it's still above its 50-day moving average. And a similar story with silver. Really shot up, seeing some profit taking, but still above the 50-period moving average. Then we look at a gold to silver ratio on top, kind of choppy lately as they both have been under pressure. We plot that against the US dollar index, but we're not really getting any insight here. The correlation between the top chart and the middle chart is neutral. It's right around the midpoint. Now, this is what we want to keep an eye on. The US dollar index. We came above 100 and then we closed back down. We were down a little bit with the dollar on Thursday and Friday. Now, if you notice, I don't have the weekly chart here, but if you watch the weekly video, the moving averages, the 50 and the 200, these are pretty far apart from each other. Where if you look at it on the weekly chart, they're almost ready to show a golden cross, which is kind of strange. But we've seen that before in the dollar, where the longer term chart actually turns positive before the short term chart. Usually it works its way, short, intermediate, long term, and then improves a little bit more until we hit the long term. We kind of see the opposite of that sometimes with the US dollar index. But if we go above 100, that could put some pressure on stocks. And then here's the euro, which has been coming down slightly compared to the dollars. The dollar's been going up. And then the Japanese yen, which is in a downtrend to the dollar, and the dollar's in a downtrend itself. So that's showing even a little bit more weakness with the Japanese yen. So here's the euro. Did tick back up a little bit here, but it's underneath its 50 period moving average when compared to the US dollar. This is the downtrend of the Japanese yen, and we're actually in a death cross here. And then the British pound underneath the 200-day moving average, but not enough yet to generate a death cross with this particular index. Then we look at the equal weight versus S&P weighted index. Now you can see we actually went up a little bit more in Friday's session with the red line. That's the equal weight version because the mega caps underperformed on Friday. And we're seeing them kind of couple back up with each other where we were seeing the red line going down with a little bit more conviction than the weighted version of the S&P. So we'll just watch this and see how that plays out. And then this is the ratio. When this is going down, that means the equal weight is underperforming, but we saw a pretty big bounce up in Friday's session. And then stocks to commodities, still, even though we ended up having a down week. We were down 1.6% or so with the S&P, but commodities really haven't been doing all that much. So stocks are still outperforming. This also is an inverted version showing how commodities are underperforming stocks. NASDAQ 100, that's pure growth. When you compare it to the S&P, which is growth and value, see how the bigger picture is positive, but we're seeing a real pullback right now. This is a market that could be getting more defensive, and it actually still declined in Friday's session. The S&P 100 actually falling below the 50-period moving average when compared to the rest of the S&P. We want the S&P 100 to be outperforming. That's when the market is more positive. Nasdaq to S&P falling back a little bit here, but still above the 50-period moving average. Nasdaq 100 is back down to its 50-period moving average when compared to the Nasdaq. And then the S&P on top here, and then we have the mega cap to equal weight. See how this is coming down? The mega caps lately really going back to the beginning of November, which was Friday, or excuse me, last Monday, the mega caps have been underperforming, but still in the bigger picture, they're looking pretty solid. Mega cap growth did pull back here, but we're still above the 50-period moving average. Small caps, okay, they bounced up a little bit here, but in the bigger picture, they continue to underperform the S&P. The red ratio, that's how the small caps are underperforming when compared to the blue index, which is the S&P itself. You can see one's been going up as the other one's been going down, even though they're on different scales. And the small caps still continue to underperform the tech sector and have now for quite some time. The Dow Jones Composite Average, which is the Dow Transports and Utilities, that's holding up fairly well there. And low volatility, still going along sideways, but actually dropping down a little bit, even though they were up in Friday's session. When this really goes up, that's another sign that the market is getting more defensive. But where we get the insight is looking at a ratio. And see how we've been coming down, but we did bounce back up, especially in Thursday and Friday session. So again, not changing the bigger picture, but just more in the short term, we're seeing the market doing a shift. And then all world stocks, when you take out US stocks, it's still looking really solid here, back down to their 50-period moving average, and then a little bit above that now. But when you put the US stocks back in the mix, we're just going sideways. Then growth to bonds coming down a little bit, but still above the 50-period moving average. And then energy, which had a good day on Friday, but not enough to overcome its underperformance when we compare it to the tech sector. And then the tech sector is still outperforming the 10-year yield, even though this has been pulling back. This is the 10-year yield underperforming, even though it's been bouncing back up here. So again, bigger picture, tech is still outperforming. Shorter term, we're seeing a bit of a shift. Discretionary to staples, seeing a bit of a pullback here with this ratio, but still above the 50-period moving average. And then staples to discretionary, underperforming longer term, but bouncing up more recently. Then gold to the S&P, just kind of chopping around. But gold was so strong there at the beginning of 2025, and then we started coming back. Then we were shooting up again, and now we're starting to come back down to the 50-period moving average. And then here with the dollar not doing all that much, gold has been outperforming. But as gold has been seeing some profit taking, we're seeing this ratio coming down. And then with our advanced decline line, the only one that is looking a little bit positive now is the S&P 500, where we came back above the moving average. All of the other indexes are still below the moving average, even though they did improve on Friday. So we have the Dow just kind of trailing off now after setting an all-time high. The transports are doing okay. We'll have to see what goes on with the government shutdown because now they're starting to monkey with flight schedules and things like that. So we'll see if something gets worked out there. And then utilities, which did set an all-time high back in early October, about the middle of October, and then it came down and now it's starting to go back up a little bit. And then we're seeing a bit of a drop off here as the transports have actually over the last, especially in Friday's session and Thursday as well, the transports outperformed the Dow. And you can see they're coming back up here, but not even back above these highs set earlier in 2025, let alone some other highs here. We're getting close to this, what could be a resistance area. And then if we do keep going up, there's other overhead resistance that we'll be watching for the transports. And a bit of a move up here, even though longer term the transports are underperforming the S&P. The correlation just going in opposite directions now. We're usually the correlation tends to stay for the most part up in this red area. It's really dropping down now. And then instead of using traditional Dow theory, we use the S&P instead of the Dow. It's coming off of recent highs here. We use the NASDAQ instead of the transports, also coming down. Not really seeing a divergence there. Then we use the equal weight version of the S&P, which did set barely a new all-time high here, but it's actually been holding up a little bit better. And then the equal weight version of the QQQs, which is the NASDAQ 100, pulling back here and didn't really bounce up that much in Friday's session. The FANG index, and you're going to see a lot of this too. Where in Friday's session, we lost the 50 period moving average, but we got it back by the close and we closed at almost a high for the session. Similar thing here with the Wilshire 5000. Below the 50 period moving average, closed back above it. So the intermediate term trend is still hanging on. We're negative in the short term, but we're still positive in the intermediate term based on 50 periods. Also, the total US stock ETF came back above its 50-day moving average. And then ARC, well, not doing so good these days, falling below its 50 period moving average, but still in an uptrend, hanging on around its 50-day moving average with the NYSE composite. And then all stocks, which are US and international stocks, pulling back, but still above the 50 period moving average. This is still looking good for the economy with high leverage loans. We're still above the 50 period moving average. Emerging markets, this is really looking a little more solid. It's off of its highs, but it's still well above its 50 period moving average. Micro caps actually falling down a little bit below its 50-day moving average, but saw a nice little bounce on Friday. And then home builders, seeing a pretty strong correlation. We're not seeing much of a divergence between the S&P and the home builders ETF currently. This is one that might turn a little more negative if we continue to be below the both moving averages. We're below the 50 and 200. The longer we stay down here, the more we might see a death cross with Bitcoin. And then the Japanese Nikkei just coming off of recent all-time highs here. And it was almost going parabolic there for a while. And then looking at some AI more related. And then later on, I'll shift over to the semiconductors. The robotics and AI ETF still in an uptrend, but pulling back into the rainbow. But we continue to see what we've seen now for quite a while, really going back to late 2021, where the robotics and AI ETF, this particular ETF, is really underperforming the tech sector. But then there's another AI and tech ETF, which is doing quite well. Now, this is what I picked out on Friday was that we came all the way down to the 50 period moving average and we bounced up and closed off of that. Now we were still down on the day, but we were well off of the lows and we actually closed a little bit higher than the open. So this 50 period moving average is holding for right now. Now we look at semiconductors. The Dow Jones Semiconductor Index came down to its 50 period moving average, bounced up off of that. It was still, again, down on Friday, but well off of the lows and closed almost at the intraday high. And then the SMH Semiconductors didn't quite get down to its 50-day moving average, but did close up well off of the lows. And we're still at the top end of the rainbow here with the SMH Semiconductor. This just is the closing prices here. And semiconductors, not down to their 50 period moving average, seeing some weakness, but then closed up off of that. And then we look at the semi to tech ratio. This is still holding up, even though it pulled back. Even with Friday's bounce, it still underperformed the tech sector on Friday. But the bigger picture is that the semis are outperforming. And then the semi to Dow ratio, that's still looking pretty good here. Now, this is some new charts here. This is a weekly chart, and I went over this in the weekly video, but I want to bring this up here. If you watch many of the videos that I do, especially on the daily side, we've been way far away from the 200-day simple moving average on a daily chart with the S&P. Well, we've been pulling back, and so we're less than 10% above that now. So then I thought, well, what about the Dow Jones Semiconductors? That's about where we found some support on Friday. We bounced up off of the 50 period moving averages there, where the other indexes actually broke below it and then came back above it. So what I like to do when something like that happens, it's like, okay, where was the support at? Well, in Friday's session, it was in the semiconductors. And then I thought, well, okay, this is showing that we're also quite far away. We're over 100% away from the 200-day simple moving average. Man, that's kind of freaky there. Okay, but that's not the freaky part, really. We're actually 111.38% above that. But as I was pointing out with the S&P daily chart to the 200-day simple moving average, when we get above 10%, that's when we start to watch this. Well, with this chart, when we get above 100%, you can see back in late 2021, that's about where we topped out. Then we went into 2022. Pretty significant decline after that. Now, we've been above this a couple of times before, but you see we had a little drop off there. Then we got way far away from it, and we saw a bit more of a pullback. This is a weekly chart, not a daily chart. And then we kind of danced around here, but didn't always mean something. And then we had last spring happen. Well, we've been dancing above this 100% level for quite a while. And so it doesn't mean that anything's going to happen necessarily right now, but this is when we want to start paying attention to this. So if we're getting a clue off the daily chart at the 50 period moving average, which is positive, and then we're able to stay above that, that could suggest that there might be more follow through in the upcoming week. So keep an eye on that one. But if we drop below the 50 period moving average, then you might want to switch back over to looking at this weekly chart here and seeing if we continue to drop down below that 100% level. Of course, there'll be other signs that we can also keep an eye on. Then moving over to internationally. Now, this is based around the KST, which is a longer term oscillator here. We're drifting just a little bit lower here on China. They were trying to turn up a week or so ago. We're also rolling over with emerging markets. Japan is still positive, but starting to roll over. We're rolling over, excuse me, in Europe. We're also rolling over and actually looking more negative now in Japan, rolling over, but haven't quite crossed below the moving average with the US. So we're seeing some global weakness right now that's starting to come into the market longer term. Then we look at another ratio of US to world stocks. This is a monthly chart. And even though we've been pulling back and in 2025 we've been underperforming, in the longer picture, bigger picture here, we're still above the advancing moving average. And we're coming down a little bit. We've been pretty much range bound here for most of 2025. But bigger picture, still looking good. Now the PPO is starting to level off and even decline just a little bit. So we'll see if we get some more strength. US stocks start to outperform world stocks. We'll see if we can get this longer term oscillator to start going up. Now, looking at the 10-year based on price, we did drop down below the 50 period moving average, but we were able to get back above that in Thursday and Friday session. But what we're seeing here could possibly be a flight to safety, getting out of stocks, getting into bonds, which pushes bond prices up, which is what we've been seeing here, and interest rates down. Okay, the total bond ETF coming down to the 50 period moving average, but still in a pretty solid uptrend there. Rolling over just a little bit as we start the new month. This is a monthly chart of the stock to bond ratio, but we're still well above the moving average, and the moving average is going up. And really choppy with the praying world bond index here. We've just kind of been range bound, but kind of a crazy range bound. It's more of a little kiddie roller coaster instead of the big people roller coaster here. All right, and then we look at the daily chart, and even though bonds have been improving, we're still seeing where they're underperforming stocks. When we look at the 10-year bond to stocks ratio, then we look over at investment grade bonds. These are more conservative bonds. They did fall down below their 50 period moving average. Now they're starting to come back up. Corporate bonds also coming down below their 50 period moving average, but we'll see if that can continue to go back up as well. And then here is the range that we've been establishing now ever since the COVID crash. And we came up out of that. This is a higher range than what we had been seeing over the last 40 years. And then the stock to bond correlation, fairly strong. So stocks based on price, bonds based on price, they're having a tendency to go in the same basic direction. And junk bonds here, holding up, fell down below the 50 period moving average, but we're able to get back above that on Friday. And then another junk bond ETF. This previous one here is HYG, high grade bonds, which can include corporate bonds. This one is more just flat out junk bonds, JNK. Gotta love that symbol. Where we're still holding out above the 50 period moving average. But we were seeing a bit of a rollover here when we look at junk bonds, more risky bonds, to government bonds, more conservative bonds. It had been coming down. We're actually in danger of seeing a death cross here with this ratio, but we're trying to come back up to the moving averages currently. And this is another ratio between riskier bonds like junk bonds and more conservative bonds like government bonds. Not really much happening here. When we look at this particular ratio, just kind of chopping along sideways at the lower end of the rainbow. This gives you a daily look at the yields and how, for the most part, they've been coming down. And then the Fed comes in the middle of October, cuts rates, and we start going back up. Go figure. All right, and then this is a weekly chart. We've been paying attention to the 10-year yield in Japan, but we've got the Japanese Nikkei just coming off of all-time highs, and they're not freaking out like they were back in the summer of 2024. So that doesn't appear to be a problem, at least at this point. And then we look at the volatility of bonds on top, which has been coming down, although we saw a little bit of a pickup here. It's still below the moving average. This is measured by the MOVE index. And then the volatility of stocks measured by the VIX. We are seeing a bit of a pickup here. And the correlation, though, is still fairly strong. When you look at the volatility between stocks and bonds, they both have been going back up lately. And then this is seeing a little bit of a pullback too. Usually we've been seeing this go down. This is bonds to stocks. And it's starting to come back up now as we're seeing a little bit of flight to safety, even though it declined a bit on Friday, but not enough to change the overall trend. And then you're going to see a lot of charts that show the same thing here. And I do that on purpose. So are we seeing the same thing throughout different markets looking at different ratios? This is the S&P 500 to short-term bonds, 1 to 3 year, coming down into the rainbow, but still longer term in an uptrend. Then you're going to see the same thing here, the S&P 1500, a broad market measure to short-term bonds, seeing pretty much that same thing. Then we switch to a different broad market measure and go further out with 3 to 7 year bonds, still coming into the rainbow here. The tech sector coming back into the rainbow when compared to 3 to 7 year bonds. And then we look at stocks to the 10-year yield had been really outperforming. It's still outperforming, but starting to come down to its 50-day moving average. So we're seeing some support levels being built here at around the 50 period moving averages, where if we can bounce up off of that, we might see more follow through upside. If we continue to drop down below this, that means there could be some more weakness coming into the market. And then a long-term chart, a monthly chart of the long-term bond here, kind of stabilizing after spending many years of actually coming down in price. And then the long-term bond to commodity ratio actually showing commodities have been going sideways, but bonds have been doing a little bit better. So we're seeing the longer-term ratio actually start to go up. And then we still see where gold's the best performing asset, even though it's well off of its highs, like 15% off of its highs here. And then a distant second, we have stocks and then commodities, bonds based on price. And then negative year to date, we have the dollar and oil. Even with Friday's bounce, oil is still negative on the year. Now we look at the sectors. Materials falling down below its 200-day moving average. They've been getting hit pretty hard lately, even though they had a good day on Friday. Kind of a dead cat bounce possibly because they're really underperforming, but starting to come up here recently. But in the bigger picture, materials continue to underperform. Communication, this has been a little bit more of a disappointment. This is another really big growth area of the market, and we held out at the 50 period moving average. Now we're starting to drop below that, and we're starting to underperform the S&P. When the market is a lot stronger, like we were seeing throughout August, this ratio really goes up. Lately, it's been coming down. Now, it's really been going sideways a lot and then started to break to the upside. Now it's starting to break to the downside. So it's still in an uptrend longer term, but we would like this ratio to go up to be more positive on the market. Energy, which is now back above its 50-day moving average after recently generating a golden cross and coming back above the 50 period moving average with the ratio of the S&P, but still underperforming longer term. Financial, still underneath their 50-day moving average and not really doing all that well when you compare it to the S&P. We have seen a little bit of a bounce here lately, but not enough to overcome this significant underperformance that we've seen going back to last spring. Industrial still hanging out around their 50 period moving average. And then when we look at it on a ratio with the S&P, recent death cross underperforming, but seeing a bit of a bounce later in the week last week. Tech pulling back as well, but still in a longer term uptrend and pulling back with the ratio to the S&P, but still also outperforming. Staples underperforming. Recent death cross. This is positive for the market. Now, if the market was getting set to be longer term defensive, at least at this point, we don't know what's going to happen down the road. We can only evaluate with the charts that we see right now. But this would actually be going up and very similar to what we saw back in, it was pretty choppy here, but in late 2021, we were in an uptrend and we were starting to see more conviction. We saw a little bit of a pullback right after the beginning of 2022 and then a big spike up as stocks really started to go down. We're not really seeing that right now. Now, it did bounce back up and it's trying to repair itself a little bit, but we're not in an uptrend right now and we're not above the moving averages right now the way we were before. Then still underperforming, but improving in the short term when we look at the ratio with the S&P. Real estate still hanging out around its 200-day moving average after generating a recent golden cross, but although it's improving, still underperforming the S&P 500. Utilities still pulling back and tried to bounce off of their 50-period moving average and showing a little bit of improvement with the ratio here, but still in a recent downtrend. We have the death cross here that was generated back in August. And we were starting to see this really improve, then pull back. We'll be watching this to see if this ratio continues to go up. That would be more negative. And we're not really seeing much here. This is a chart I quite often show in every daily video, but lately I haven't over the last few months. Pretty much it's off and on in 2025 because it's been so choppy lately. Then healthcare, which is more defensive, seeing a little bit of improvement along the way here and actually generating a recent golden cross and holding out above its 50-day moving average, but still a long ways to go to start outperforming the S&P. It's still continuing to underperform, even though it has been improving. Discretionary still hanging out around a little bit underneath its 50-day moving average and underperforming the S&P. This has been one of the more disappointing areas of the market. We look at a discretionary to staples ratio, and that's doing okay, but not great. And then we look at a discretionary to S&P ratio, and this one's not looking all that good right now. And then some different correlations. We see where the dollar and stocks are having a tendency to go in the opposite directions of each other, and where oil and the S&P are tending to go in the same direction, up on up days, down on down days. And then we look at stocks to the 10-year yield. They're tending to go in opposite directions. The tech sector to the 10-year yield just coming out of being neutral, but leaning more towards going in opposite directions. And also still neutral, but leaning a little bit in opposite directions when we look at stocks to the 2-year yield. Then some long-term charts here. A monthly chart of the NYSE. Still looking good, rolling over a little bit here. We're seeing some weakness lately, but we're still above this long-term moving average. But we're still continuing to decline with the Copic curve, which is a momentum oscillator. Also, monthly chart here, the NYSE, we have been doing a lot better with this NYSE record high percent index. Lately, it's been starting to pull back. And this has been one of the stronger areas in 2025 for the markets that we see this longer term showing some weakness. That's a little bit of a concern to us. And we're rolling over here with the PPO or the percentage price oscillator. We're rolling over a little bit based on price, but we're still well above the moving average with the S&P. And then we look at another S&P monthly chart and a stock to commodity longer term. This is still going up, but we haven't seen a golden cross where stocks are starting to outperform commodities longer term. Then another US to global index here, still hanging out around the long-term moving average. But the KST, the long-term momentum oscillator, is continuing to decline. All right, then I go through all the positive things here, and nothing has changed. The only one that's really bringing up a bit of a warning right now is Bitcoin at the very bottom. And we're seeing some weakness. It's hanging out below its moving averages and in danger of seeing a death cross unless we see some pretty positive price action pretty quickly. And then on the negative side, we just have the dollar index by itself, and then the Japanese yen also compared to the US dollar. Both are in downtrends. Thank you. I hope you found this helpful. I hope you're having a great weekend, and I will talk to you in the next video.